How a private equity fund is structured. Have you ever wondered where all these big private firms, companies, and individuals invest in, making the large sums of money they do? Have you ever heard of the term private equity fund? Do you have an idea of what it entails and how it is structured? 99% of the world's total funds are accrued from private equity. Why? Because they tend to get more significant returns compared to the rest of the market. The term private equity, according to Investopedia, is an alternative investment class and consists of capital that is not listed on a public exchange. It is composed of funds and investors that directly invest in private organizations or delist public companies. This definition is a bit too difficult to understand from a layman's perspective, so I describe it simply as personal finances or funds invested in various businesses for their improvement and to make returns. If you have a hard time understanding delisting as well, it is the public shares that are no longer available on the stock exchange platform. I would like to welcome you to today's video. I know I have spoken a lot already, but today we will be discussing an exciting business finance topic. I will do my best as we go along to explain in very straightforward terms for better understanding. Today's discussion will be about private equity funds and their structure. Number 1. A flat structure. Now, I wouldn't say much about this because it is very much easily understood. A private equity fund, as I stated earlier on, is investing your money in a private equity firm to make returns. In a flat structural firm, the level of management between managers and employees or staff are very few or absent. So, for a flat structure, there isn't a high hierarchical structure consisting of different levels of managerial offices above the staff. Number 2. Closed-end. A closed-end investment, according to Lexology.com, follows a limited fundraising period. Investor capital commitments that are drawn over time, defined investment period, fund term, and no ongoing subscription or redemption rights. What this is basically saying is that once an individual, company, or group of individuals invest money into a private equity fund, there are laid down procedures defining the capital or money invested and the stipulated period of time allotted for which money cannot be withdrawn. Number 3. The general partner. We are about to now look into a more detailed structure of private equity fund. The first thing we will talk about is the general partner, commonly called the GP. So, the general partner is the main overseer or ruling partner over the fund and other limited partners, which we will talk about subsequently. So, the GP comes up with the idea of, say, investing in real estate opportunities and companies. He then goes to look for other investors who can contribute capital for the investment. The bringing together of the various monies is what is termed the fund. The governing partner in a private equity fund has an unlimited liability. That is, he risks losing other assets besides the capital he invested. We will discuss this more as we move on. Number 4. Limited partnership. You remember I spoke about the role of the general partner and how he comes up with the idea for the investment and solicits potential investors. Well, the other investors, which may include high net worth individuals and a variety of institutions investing directly into the fund and acquiring ownership, are known as limited partners. For clarification, let's take for instance a GP who comes up with the idea of investing in real estate. He contributes $10 million to the fund. 3 other high net worth individuals contribute $7, $5, and $3 million respectively. The total amount becomes $25 million, and that is what is labeled as the fund. The limited partners, unlike the general partner, have a limited liability. This means that in the event of loss, they only risk losing capital they invested into the fund and not their personal assets. Number 5. The Bible. If you have gotten this far without subscribing and giving this video a thumbs up, I would entreat you to do so. Moving on, when it comes to what is referred to as the Bible in private equity structure, I have decided to divide it into 2. This first part will describe it in generality, and the last point will go into detail. So, this is a relatively large and expensive book containing draft and outline of agreements and documents pertaining to the investment, and the acceptable parameters for investment. The GP is in charge of creating the rules and regulations. He writes it for his own will because he has the final say when it comes to matters concerning the investment. Note that the general manager is responsible to the certified documents which have been approved by the limited partners as well, and not to individual investors. It also determines the mode of payment, which I will be discussing next. Number 6. The waterfall structure. In every private equity fund structure, note that there is what we call the registered investment advisor, who advises the equity and its partners on investments and have an obligation to provide investment advice that serves in the best interests of their clients. Now, in this second part of the Bible, I'm going to be discussing two governing documents known as the Limited Partnership Agreement, or LPA, and Private Placement Memorandum, known as PPM. When different partners come together to invest in the fund, they sign an LPA agreement and PPM agreement and approve the content of the document. What the document entails is what your investment fund is allowed to do and what not to do. The LPA and PPM is found in the Bible, and once it is approved and agreed by limited partners, the GP can go ahead having full control to invest in the said business. When the fund begins to make returns, the general partner is paid what is known as the performance fee. This is tied to the capital successfully raised or the assets under management. The limited partners are paid preferential amount and carried interests. Catch-up funds are also invested back into the system to sort of set them on track again. All these are done for the stipulated allocations permitted in the documents. Some strategies private equity funds pursue include distressed funding, leverage buyout, real estate, venture capital, etc. A distressed fund involves investing in struggling companies in hopes of turning it around and making returns, or subsequently selling it to a larger company and making profit. Leverage buyout is the total takeover of a company. Real estate is investing in property development projects, and venture capital involves investing in entrepreneurship. I hope you have enjoyed today's video and have gotten educated on private equity fund and its structure. If you haven't subscribed to this channel, once again, remember to do so and like the video as well. Till I come your way another time, enjoy the rest of your day.